Hello there, welcome back to this Forex teaching series. So today's class is a continuation of our last lesson. We stopped at PIP, and because of the time frame, I never wanted it to exceed 1 hour, so I decided to stop that lesson for that day. So today it's just a continuation of the previous class, and we were supposed to discuss PIP, PIP, PIP. So PIP is an acronym actually for price interest point. The first P means price, second the I there means interest, and the last P means point. Some call it percentage in profit. The first P means percentage, I means in, and then the last P means point. Sorry, percentage in point, not profit. Percentage in point. So price interest point, percentage in point, they can be used interchangeably. Okay, but the main point is because it's just for you to understand what PIP means. They call it percentage in point because it's a difference in the change of value. Currency rates always change. They've changed it in seconds as a result of economic activities. Economic activities that take place all over the world. Okay, as a result of global economic activities, there are changes that take place. Sometimes some countries' economy may be stronger than others, which will warrant their currency to be stronger than other countries' currencies also. Alright, so a pip is simply the basic unit of measurement of value when a currency pair moves. The basic unit of measurement of value when a currency pair moves. For example, if a currency pair moves 1 pip from 1 to 2, the difference there is the pip. If it moves from 1 to 5, the difference between 1 and 5 is what we refer to as the pip. Okay, and that is where your lot size is measured, or the profit you are making in this business will be measured depending on the position you open, be it a standard lot, a mini lot, or a micro lot. Alright, so remember we talked about currency pairs like the Euro US dollar, Euro GBP, CAD JPY, etc. You always see a quote attached to each currency pair showing the exchange rate, which changes constantly almost every second. Now, these codes usually have 4 digits after the decimal point, but most brokers will add a 5 or a fifth digit or number called pipette or fractional pip. So today's class is on pipettes and fractional pip. We are going to see what a pip. We already started talking about what a pip is, and then we also talk about what a pipette is. So, like I said, on each you will always see a quote that is attached to currency pairs that shows the exchange rate. Those rates changes every second. They changes almost every time. You see them, it changes very, very fast. By the time we go on a live market, you are going to see them. All this explanation, by the time we get to live market, they are going to, because I believe by then you should have absorbed this information in your system. You should have understand all these things. So when we get to a live market, nothing will be strange again. It's just going to be replaying in your memory, in your mind, like, okay, this is what we're trying to get. This is the picture. So I'm just trying to paint a mental picture of what you are expecting. Okay. So this code normally will come in 4 digits, but some brokers will add a fifth number. The fifth number there is the fractional pip, while the fourth digit is the pip. It is usually written with a subscript or a superscript, all depending on the broker. Now, these changes in values, we call them pips. And the difference between the currency pairs or quotes is the spread, which the broker takes as their charges. Okay, so I have a small, we have two currency pairs, one currency pair actually, but they are there for explanatory purpose. These 3 above here and these 3 below is written in subscript and superscript. They are the pipette. They are the pipettes. They are the pipettes. P-I-P-P-E-T-T-E. They are what we call pipettes. The last three above. Let me circle it again for clarity. These three and these three are they are what we refer to as pipettes. Then the pip is the fourth digit after the fourth digit after the decimal point. Before the decimal point, we have 1. The first figure before the decimal point is 1. Then after the decimal point, you have 3, 9, 0, and then 1. Excluding this 3 that is above here, excluding that 3. Now, the fourth digit after the decimal point, which is after the decimal point, you have 0.3901. The 1 there is what we refer to as the pip. Okay? The 1 is what we refer to as the pip. While the 3 that is written as a subscript or a superscript is what we refer to as the pipette. So that is just it. And we call it fractional pip sometimes because the pipette is actually 1/10 of a pip. 1/10. So this is a fraction. Remember your elementary mathematics very well. This is a fraction. Okay? That is the reason why we call it fractional pip, because it is 1/10 of a pip. So 1 divided by 10, it is a fraction of a pip. That's why we call it fractional pip. But ideally, the real name is pipette. But they call it fractional pip because of it is 1/10 of a pip. And anything written as 1/10 is a fraction. So that is why it is called fractional pip. But the point is that it is negligible. I do neglect it on the trading platform. I don't really look at the fractional pip. Okay, some broker they don't really write it as subscript. They just write direct 1.39012. They write it bold, completely bold. This is the pipette. The 2 here is the pipette. Okay, why this one here? The 1 here is the pip. This one, that is the pip. 2 is the pipette. So if you are counting after the decimal point, the number 4 digits, the fourth digit after the decimal point, 3901, is the pip. I hope this concept of pip and pipette is clearly understood. Now, it is the pip that changes in values. That is why we call them pips. Okay, we are going to see it live on a trading platform. It changes in value constantly. So that is the pip. So pip is just is a unit. That's why we call it a unit of measurement. That's why we call it a unit of measurement, or a change in the price or quote of a currency pair. So those changes are what we call pip. Okay, you can see that sometimes they will say, if you see a trader say the euro US dollar have moved 50 pips, 50 pips today. Now these 50 pips, it all depends on the position you open with it. If you open it with a standard lot, which is $10 per pip, which is $10 per pip, $10 times 50. Okay, whatever you have is your final answer. I mean, it will be your money that you make. Okay, so if you are going to look at this concept of trading very well, we are entering our position in lot sizes or trade sizes. Is either you are opening a micro lot, a mini lot, or a standard lot. Then the pips is what we calculate our money in. Okay, so it's not like the normal market. You just go that, oh, I want to go to market, and you are using naira to buy biscuits, to buy foodstuff, to buy rice, to buy beans. But in trading, it is in lot sizes. In lot size, I believe I've already done justice to lot sizes. Lot. This is how we open it, or trade size. Lot size or trade size. And we have one standard lot. Sorry, we have the standard lot, we have the mini lot, and then finally we have the micro lot. But nowadays, if you are opening a position less than the micro lot, it is called a nano lot. Okay, and if you open a trade, as the currency values are exchanging, as there are changes, your money will be measured in what we call pip. Okay, this is just a summary of this pip and pipet. Now if you see a fifth number on after the decimal point on any broker's platform, that one number is known as pipet or fractional pip. We call it fractional pip because it is 1/10 of a pip. And fractional pip, the name fraction because we say 1/10, 1/4, quarter, half, like that. They are all fractions. Remember elementary mathematics, they are all fractions. Okay, so let's make progress. Okay, here is just an image or a slide that I drew just to further explain this concept of pip and pipet. The currency pair can be any currency pair. Okay, it can be any currency pair, but there are exceptions when it comes to yen pairs, that is Japanese yen pairs. Any currency pair that is attached to Japanese currency, the normally we only have 2 digits after the decimal point. Okay, but I will go back, I will come up with a slide with that for clarity. So here, this one here is the pip, 3 here is the pipet. I hope it is clearly understood, or fractional pip. Okay, that is the pipet or the fractional pip. But for the Japanese yen, any currency pair attached to the Japanese yen, like let's say Canadian dollar JPY, for example, CAD against JPY, Japanese yen pairs, instead of having 4 digits after the decimal point, we usually will have something like just 109 point, let's say 59. Okay, now the second digit after the decimal point, which is 9 here is the pipet. Now for all Japanese yen pairs, CAD JPY, GBP JPY, USD JPY, what more again, NZD JPY, which is the New Zealand dollar. For any currency pair attached to the JPY, where the JPY is coming as the quote currency or the secondary currency, the quote will always look like this. Only 2 digits after the decimal point. Okay, but in normal currency pairs, we have 4 digits after the decimal point. That is how the yen pairs or the Japanese yen pairs are arranged, and that is because of maybe economic factors, or maybe that is due to the fact that the Japanese yen is slightly lower in value than the other currency pair, like than the US dollar or other pair, maybe other major currencies. Okay, so maybe that is the reason why it is like that. But just have it in mind that Japanese yen pair. So in case you see it on the trading platform, don't go and make any mistake that the person that taught you said currency pairs wish to have 4 digits, or maybe you see 2 digits now. You now be wondering, how this one have 2 digits? How will I know the pip? No, it is like that. It is always 2 digits after the decimal point. That is the pip. So the second digit, which is 9, is the pip. We have 109 points. The point is the decimal point. 109.59. The second digit after the decimal point is the pip. Now, how do you the pipet for Japanese yen pairs? We also always have a third digit. Ideally, just like every other currency pair that have 4 digits after the decimal point, just like the way you are seeing them here, like this. Then the fifth digit, if there is a fifth digit, it is called the pipet. So for the Japanese yen pair, that you have 106.95. The 5 here is the pip. The 5, which is the fifth number here, that is the pip. But you will now, if the broker is making use of pipets, you will see something like 106.954. The 4 there now is the pipet. This 4 is the pipet. I hope it is clearly understood. This 4 is the pipet. Okay, when you are using any currency pair that have the Japanese yen attached to it. All right, let's make progress. Okay, so here is another example to illustrate, to explain further the Japanese yen pair. This is US dollar against Japanese yen. Okay, this is US dollar against Japanese yen. On this slide, just like I explained to you, just like I've already explained, we have the Japanese yen will always have 2 digits after the decimal point. Okay, 103.71. 103.69. This 71 is because it has moved 2 pip. So have it in mind that it is the pip, the last number. This number is what is increasing. Those numbers are what is increasing. So this is 69. When you add 69 plus 69 plus 2, what do you have? 71. That is why you have this 71 here. So 103.71 is the currency quote. 1 is the pip. Okay, 1 is the pip. Remember, the second digit after the decimal point for Japanese yen pairs, all the currency pairs attached to the Japanese yen, or that is the base currency, sorry, the quote currency or the secondary currency in all major currency quotes. The second number is the pip. If there is a third number, sorry, it is called the pipet. Normal quotes have 4 digits after the decimal point. I'm repeating myself constantly because I want this to sink in. Normal currency quotes have 4 digits after the decimal point. If you see a 5th digit, that is what we call the pipet. Okay, but for Japanese yen pairs, they have 2 digits after the decimal point. The second digit after the decimal point is the pip. While if you see a 3rd digit like this, it is the pipet. So you can see as clearly explained here. So this 0 is the second digit after the decimal point. That is the pip. The 4 here is the 3rd digit after the decimal point. That is the pipet. Okay, so should in case you are using a broker that is adding a 3rd number after the decimal point, that is the pipet. Second number pip, 3rd number pipet. But the entire currency code for Japanese yen is always written like this. Okay, so that is the differences between the currency codes. But that's all. There's no any other difference. There's no other currency that have a different currency pair again. Every other currency pair have 4 digits or 5 digits. If there is 4 digits, that means there is no pipet. That is the pip. The 4th digit after the decimal point. Forget about what is before the decimal point. Okay, just scratch your mind off what is the day before. This is 103. Just remove it. What you are looking at is here 704 after decimal point. Okay, here is another example again. Look carefully. If you look carefully, you will see that this is the Euro US dollar pair. Euro US dollar pair, where the entire of this area is illustrating what pip means. Okay, why the entire of this area is illustrating what the pipet means, right? Like I told you, normal currency codes have 4 digits. Normal currency codes have 4 digits. These are the 4 digits after the decimal point. 1081. Okay, so the one there, the last one there is the pip. 1 pip, that is the pip. Okay, but if there is a 5th number, as you can see here, 2. If you count, this is 1, 2, 3, 4, and then 2 here is 5. That 2 is the pipet. 1, 2, 3, 4. The fourth number is the pip. Now look at for the Japanese yen. For the Japanese yen, US dollar, Japanese yen, as you can see here, USD JPY. There are this. Here is the currency code. The second digit after the decimal point, which is 3. Before the decimal point, we have 4 and 3. So like I told you, the US dollar, the JPY pairs or any currency pair that have the Japanese yen attached to it, you always see it like that. What you are looking out for is just the second number after the decimal point. Forget about what is before the first the decimal point. Any value before the decimal point in any currency pair, forget it. Just focus your attention on the values after the decimal point. 432. The 2 there is the pipet, okay, while the 3 is the pip. Alright, I believe this is clearly okay. So here is a broader explanation for the pip. Okay, now what is the pipet here now? Sorry, what is the pip here? If you count for this Euro GBP pair, this is Euro GBP pair, and the market is moving. Okay, this is the currency pair, then this is the currency quote. This is the currency quote up to 9. I think there's still a value below. Okay, so those are the currency quotes. That is the currency pair. Now if you look very well, this is 1.3900, 1.3901, 1.3902, 1.3903, 4, 5, 6, 7, 8, and finally 9. Okay, if you look carefully now, the numbers are increasing. So the last digit is the pip. Okay, so you can say that this Euro GBP pair has increased by 1 pip, it has increased by 2 pips, it has increased by 3 pips, it has increased by 4 pips, 5 pips, 6 pips, 7 pips, 8 pips, and 9 pips. Okay, that is if it is increasing. Now imagine it's the other way around, that it is decreasing. Okay, instead of from 1.3909, we move to 1.3908 to 1.3907, 06, 5, 4, 3, 2, 1, like that. Okay, so that is how the market moves. The market will either move upwards and downwards. Okay, it's going to move in your favor or against your favor, against you. Okay, so for those who normally give signals, this is how they give their signals. After doing all this analysis, they will not look at it like, okay, they have done their homework. All right, they will tell you to enter your trade at, because the market, let's say this is an uptrend now, because the market will move according to these values you are seeing, like this. Okay, so maybe you enter your trade at 1.3910. Okay, so and then the trade now increase, or the market moves in your favor, it goes upwards. They will tell you, maybe the person who gave you the signal will tell you to exit your trade at 1.3903. Okay, so the distance move now is, let's say this is the number of pips that you have accumulated, which is, let's count now, we have 1, 2, 3, 4, 5, 6 pips, right? And then let's say you enter a position of one standard lot, okay, which is 1.0 on the trading platform. And we all know that a standard lot move with, if for every pip move it is $10, right? And now you have moved 6 pips. That will be 10 times 6, which is equal to $60. If it is pounds you are using, that will be your denomination. If it is naira, that will be in naira. If it is euro, that will be in euro. Okay, it's all right. Now this this is applicable to all lot sizes, which is standard lot, just like I have explained, which is standard lot, which moves $1 per pip. So if you open it for a mini lot, which is standard lot is $10 per pip, sorry. Then the next one is the mini lot, which is $1 per pip. So for that 6 pip that you made times 1, that will be $6, right? The next one move 10 cents per pip. Okay. And then for nano lot, if you're opening a very tiny position, which is 1 cent for each pip that is moved. All right. So how much is a pip worth? We've already talked about it. In the forex market, we have basically 3 trade or lot sizes. We've sing about this countless times. We have the standard lot, mini lot, and micro lot. Starting with the micro lot, which represents just 1,000 units of currency. Example, euro US dollar, euro US dollar, Canadian dollar, Nigerian naira, Ghanaian cedi, Japanese yen, etc. Okay, and on your trading platform, to trade with a micro lot, you need 1,000 units of currency. To trade with a micro lot, you need 1,000 units of currency. Okay, you need 1,000 units of currency. And that 1,000 units of currency is written as 0.01 on the trading platform. 0.01. So that means if you want to open a position of a micro lot, you just go to your trading platform and just look for 0.01. Very simple. Then for every pip that you are making, whether you sold in the market or you bought the currency pair, it is 10 cents. Okay, it is 10 cents. You can still open for 0.02, which is 2 micro lots. 0.03, that is 3 micro lots. 0.04, which is 4 micro lots. 0.05, 0.06, 0.07, 0.08, 0.09, 0.010, like that, etc. For the ninth one, that is 9 micro lot sizes. So just like I told you, you are not limited, because I said a micro lot is 0.01 and you need 1,000 units of currency. No, it all depends on your margin or what you have in store. Okay, it all depends on the margin or the money you have in your bank account. That is why we are not using, I'm using the forex market terminologies for you. Margin is always the money you have as your down payment. I've already talked about that in leverage. I may touch it here again before I end this class. Okay, all right. So the next one is the mini lot size. I hope you are getting what I'm saying. All right, the next one is the mini lot size, which is the next big trade size in the FX market, and it is 10 times larger than a micro lot. Okay, each of these lot sizes are 10 times larger than each themselves. Basically we have 3, but there is an inclusion of a nano lot more recently. All right, they are 10 times larger than each other. All right, so in your trading platform, a mini lot is indicated as you need 10,000 units of currency to trade a mini lot. You need 10,000 units of currency to trade a mini lot, and it is written as 0.1 in your broker's platform. Remember, micro lot is written as 0.01, right? But for the mini lot, it is written as 0.1. So you can see that the difference between this is 10. So the micro lot, the mini lot, sorry, is 10 times larger than the micro lot. So one mini lot, if you are going to trade one mini lot like this, you need 10,000 units of currency. Okay? If you are going to trade two mini lots, what do you need? You multiply it by 2. You need 20,000 units of currency. And if you are making $1 for one mini lot, if you are now trading two mini lots, which is times 2, you'll be making $2 per pip. If you are going to trade three mini lots like this, you will need 30,000 units of currency, and times 3, you are going to be making $3 per pip. I hope it is clearly understood. So instead of point 1, instead of point point 1 like this, instead of point 1, you are going to put point 2. If you want to trade two mini lots, it's going to be point 2. If you want to trade three mini lots, it's going to be point 3. Okay, so the higher the lot size, the higher the profit you'll be making. Point 9, that is, you need 90,000 units of currencies. All right. Now, finally, let's go to the biggest trade size, which is the standard lot. Okay. Now, for a standard lot, which is the largest trade size in FX, it is 10 times larger than a mini lot with 100,000 units of currency and a trade size or volume of 1.0. So, remember the micro lot, you have 0.01. For the micro lot, you have 0.01. For the mini lot, you have 0.1. Then for the standard lot, you have 1.0. The difference between each of these 0.01, 0.1, and 1 point is 10. So they are 10 times larger than each other. Now, to trade if what is 10 times larger than a mini lot, which is $10,000 for one mini lot, it is 100,000. You multiply that by 10, you get 100,000. So you need 100,000 units of currency for you to open a position size of 1,000 lots. Okay, so let's say your trade moves 10 pip, or your trade move 80 pips on a standard lot. What are you going to do? You multiply that 80 by 10, that will be 800. Okay, that is the amount you have made. All right, let's quickly talk about leverage and margin again. So remember, I said margin is a down payment. Okay, let's say you have a $5,000 in your bank, in your portfolio or in your trading account, $5,000. Then you now take out $1,000 as your margin, or you choose to take out $500 as your margin. The margin is a down payment. That is the amount now that you have set aside to open a trade. Okay, that is the amount you have set aside to open a trade out of all the money that you have. You have 100,000, you decide to remove 1,000. You have 100,000, you decide to remove 10,000. You have 100,000, you decide to remove 20,000 as your margin or as your down payment. Okay, if you remove 20,000 out of 100,000, you are left with 80,000. So that down payment is what you now use, and it will now be in your balance. So it will now be in your margin on the platform or on your broker's platform. Okay, now let's see this clear example here. Let's say you have you have $1,000 in your balance. Okay, you now decide to remove $100 as down payment. That is your margin. That is what we call margin. Now, if your broker is offering a leverage, I already told you what leverage is. Leverage simply means your purchasing power, or the purchasing power that the broker give you to open bigger position. It is an increment. You have $1,000. Let's say, bring your $1,000. Let me give you $100,000 to go and do business with. Okay. You have $1,000. I say, okay, bring $100. Let me multiply it for you to do business. So that is leverage. Leverage is just like an increment, as we are going to see here. And most leverages, they are rating in ratio. You know what ratio is? In your elementary mathematics, ratio is something that have double column. Then you have one figure in the front and another figure behind it. Now, if you are going to call it, you are going to say this is 1:1. Okay. So you have, let's say for example, now the broker is giving you 50. The broker is giving you 50:1 as their margin, as their leverage, sorry. So that means they are willing to multiply your whatever amount you are putting in as your down payment times 50. Okay? 50:1. Your broker is willing to multiply it by anything you are putting. So let's say you are putting $100. If they multiply $100 by 50, you have 5,000. You just deposited $100, but you have the power to open a trade size with $5,000, but you actually deposited $100. That is the power of leverage. And if you are opening a position of $5,000, that is 5 micro lots, because a micro lot you just need $1,000, right? So you can use it to open 5 micro lots. Okay. Now let's say if the broker is giving you a leverage of 100:1 or 100:1. That means they are willing to multiply any amount you are putting in as your margin or as your down payment. They are going to multiply it by 100. They are going to multiply it by 100. So let's say you are putting $100 as your down payment or as your margin. 100 multiplied by 100, that will give us 10,000. Okay, so that means with your $100, you can open a position size of 10,000 units of currency. Okay, and that is 5 micro lots. If you multiply it by 10, it's going to give you a mini lot. That means you can open a mini lot, which is 10. And you know, to open a mini lot, you need 10,000 units of currency. That is one mini lot. All right. Now let's look at other examples. Let's say if you want to trade 7 mini lots, you already know that one mini lot is 10,000, right? But you want to open a position of 7 mini lots. So how much will you need? How many units of currencies will you need? You need 70,000 units of currency. You need 70,000 units of currency to open a position of 7 mini lots. This is just for example purpose. Okay, and if you are going to do that on your platform, it's going to be like 0.7, just like I've explained in the last one. It's going to be 0.7. I just hope you are getting these concepts. A mini lot is 0.1, right? And you need 10,000 units of currency to trade one mini lot. But if you want, and then if the mini lot, if it moves 1 pip, you are making $1. Okay. All right. So if you want to open 2 mini lots, it's going to be 0.2. 3 mini lots is going to be 0.3. If 1 mini lot is giving you $1, 2 mini lots will be giving you $2. 3 mini lots will be giving you $3. Then you want to open a position of 7 mini lots, you'll be earning $7 for 1 pip that the market move. Now, to open a position of size of 7 mini lots, you need 70,000 units of currency. If the broker is offering a leverage of 100 to 1, that means whatever amount you have, you are going to multiply it by 1 so that you will know how much you put as your margin. Okay, now you already know that 70,000 is the number of mini lots that you want to open. 7 mini lots is going to worth 70,000 units of currency. You divide that 70,000 by 100. What do you have? You have 700. So 700 will be your down payment. 70,000 divided by 100, you have 700 as your down payment. So if you multiply 700 by the leverage your broker is offering, which is 100, you are going to get 70,000 units of currencies to open your 7 mini lots position size. Okay, for the purpose of time, I'm not going to look at other examples. They are just the same thing. I'm just changing the lot size and the rest. This one is for the standard lot. To trade a standard lot, you know that each standard lot that you are trading, you are making, if the market move by 1 pip, you are making $10 for that. Now, if you have opened a position size of 80 standard lots, that will be 80 times 10. That will be $800 per pip. So whatever you are opening position size, just multiply it by 10. Okay. Now, account balance. All the money in your account is your account balance at the start of the trade. All the money in your account is your account balance at the start of every trade. Account balance. Now, the equity shows your balance. This equity here, if you are, all these are what you are going to see on your trade platform. Account balance, equity, margin, free margin, and then margin level. All this you are going to see it just below your trading platform. Okay, now the equity now, for example, let's say you have a trade of, you have a position of, you have opened you have a margin of 1,000, which is your down payment, right? And your broker have already multiplied. Let's just say you have 1,000, for example. Let's forget about leverage. Now, let's say you open a trade and you have made $100 in profits already. It is not going to show in your equity or in your account balance as 1,000. Why? Because as 1,100, because this is your profit, $100. You are supposed, I know normally you are supposed to see it as 1,100, but your 1,000 equity will just be there. Your 1,000 in your account balance rather, or in your margin, will be there. All right, but this equity, that is where you will see 100. By the time you close your trade, your account balance or your margin will now show 1,100. Why? Because the trade is still live. It cannot go to your account balance unless you close the trade, because the trade is still running. But if you have closed the trade, everything will now show in your profit. The same thing happens if the market is going against you. Let's say you have $1,000 in your balance and the market is going against you. Let's say you are already down by minus 100. In your account balance, it will not show. If you subtract 100 from 1,000, what do you have? You have 900. It's not going to show 900 units of currency in your account balance. It's still going to show that 1,000. The only time you will see 900 is when you have closed the trade. Now you have closed the trade in loss, because the market can still reverse in your favor. That is why it is like that. You may have a minus 100, but later if the market reverses in your favor, you have maybe plus 100, plus 200. Until you close that position, that is the only time you will see that the money will not be deducted from your account. I hope this concept is clearly understood. Now we have what we call margin. Already know that is the amount of money that you have paid, drop as your down payment. Then free margin is the amount of money left to take more trades. Okay, that is your free margin. If your trade is running in profit of 1,100, your free margin will be increasing. That free margin now you see 1,100. That means that your trade have opened. Maybe let's say you open a nano lot size or a micro lot size, and you have made 100 units of currencies. That 100 you can still add it up and further open more trades. Alright. Now the margin level is shown in percentage, which is the last one. Margin level is shown in percentage. It displays your account balance. It displays your account performance. Sorry. There's what we call margin call. Margin call. Call. C-A-L-L. Just like to call. The margin call is a system that most brokers have devised in their trading platform. Let's say the market has gone against you totally. Let's say you have a $1,000 in your account and you have opened a high leverage trade of one standard lot, or let's say 5 standard lots or 10 standard lots, and the market goes against you. By the time the capital that you have, because if you remember, if you have been listening to this class very well, I told you that for you to open a position size, you must have particular number of units of currencies. To open one standard lot, you must have 100,000 units of currencies. To open a micro lot, you must have 10,000 units of currency. Sorry, mini lot. The micro lot, you must have 1,000 units of currency. Okay, and let's say you now open one standard lot with a 1,000 units of currency account, and the market goes against you. If it has reduced to 500, that means you can no longer open a position. You can no longer hold a position of one standard lot. You cannot hold a position of one standard lot. So the broker will automatically close all your trades. Automatically it will close your positions in loss. But let's say you still have small amount in your account. Now you cannot open one standard lot. You cannot use it to open maybe a micro lot or a mini lot. Alright, so let's see leverage again. Alright, to further explain the concept of leverage. Alright, look at the first. Just look at this area here. We have 2:1, 10:1, 50:1, 100:1, 150:1, 200:1. That is the leverage that brokers are offering. For example, now let's say you only have 1,000 in your account. Let's say you are now working with a broker that is offering 2:1 leverage. That means your 1,000, the broker is willing to multiply it by 2. Then you now have a purchasing power of 2,000. If you are working with a broker that is giving you a 10:1 leverage, like this, they are willing to multiply your capital that is invested, which is your margin. They are willing to multiply it by 10 times to give you 10,000. Let's say you have a broker that is giving 50:1 leverage, and you have 1,000 in your balance. That means that 1,000 into 50 times, that will give 50,000. That means you can open a position of 50,000 units of currency. 100:1 multiply. That means the broker is willing to multiply by your capital invested or your down payment or your margin by 100 times to give you 100,000. If it is 150:1, it means your broker is willing to multiply it by 150 times. 1,000, that will give you 150,000. Finally, if it is 200, your broker is willing to multiply your down payment, which is 1,000, times 200 times, which will give you 200,000 units of currency. Now, these are just small leverages. There are brokers now that give up to 2,000. So they will give you 2,000:1, 1,500:1. So these are high leverages. It is sweet and it is also dangerous. Leverage. It is very sweet and at the same time it is very dangerous. It is sweet if the market is going in your favor. And it is dangerous if the market is going against you, because the rate at which you are making money is the same thing. It's the same rate at which you'll be losing money, depending on the the lot size that you open. If you open a micro lot, or let's say if you open a mini lot, which is supposed to be giving you $1 for each pip, if the market is going in your favor. If the market is going against you, you will be losing $1 for each pip that the market goes against you. If the market goes in your favor, you will be making $1 for each pip that the market goes in your favor. So that is why the market is constantly fluctuating. It goes up, goes down, goes up, goes down, goes up, goes down, goes up, goes down, like that. Okay? It's alright. So this is just a recap of the a continuation or the final part of this segment of this trade or of this session. Now, there is an assignment I would like to give you. Question number 1. Let me think. I'm just thinking this thing off hand. Let me see. What will be the value of your unit of currency? Or what will be the value if market move 20 pips in your favor? What will be the value? Let's say you open a position of one standard lot. One standard lot. Remember how many dollar per pip is a standard lot? Okay, so you open a position of one standard lot, and then the market moves in your favor by, let's say, 30 pips. You open a position size of 1,000 lots, the market moves in your favor by 30 pips. What will be the final value? Or what will be the amount that you have made on that trade? And then the second question. Let's say you open a position size of a mini lot, and you know that the mini lot is $1 per pip. Okay, now what will be your final value if the market moves against you by 40 pips? I ask the question again. You open a position size of a mini lot, and the market moves against you by 40 pips. What will be the amount that you have lost in that market or in that trade? Having said that, we've come to the end of this session of this class. In our next lesson, we are going to further explore the world of Forex. I will not tell you the topic. You just stay tuned. Okay? So we are going to continue this class tomorrow. Alright, study everything that you have learned. Don't just sleep on it, please. Whatever you are learning here, you have to study it. Don't just listen to what I'm saying. Whatever I've used, whatever I've said here, you can still make your personal research, just like you've been doing. Make your personal research. Try to not memorize these things. Just study them, because you are not cramming them, because everything is like automated on the platform. That's why I told you on the trading platform is very, very simple. It is automated already. But this is just how the market behaves. This is how they calculate everything. This is how everything works. This is how it functions. It's alright. So we have just moved one step up the ladder. See you on the next step. Take care. Goodbye for now.